I presented a paper to this group, and I thought that rather than going through the paper either briefly or ploddingly or reading it, since it's already out there for you, you can read it yourselves, and I commend it to you because I just read it again myself. It's excellent. So what I thought I'd do at this meeting is sort of address kind of either what you might think is either the appendix or maybe address some of the criticisms ahead of time that people might bring up. And the first point I would make to add to Geoffrey's excellent presentation is that I think he left one thing out, because I totally agree with him. There are fundamental problems with regulation in principle. But one thing he left out is that if you regulate banks, your crises are guaranteed to be systemic, because they're all going to follow the same rules. So they'll all be doing the same thing at the same time, to the same extent, and therefore you won't have individual banks going because their particular strategy fell foul of events. You'll have all the banks either succeeding or failing together. And that also should be something I think we should probably avoid. So obviously from the taxpayer's point of view, what we want to avoid is this big sudden cost and additional burden to the public purse of banking crises. And from the point of view of what we're sort of doing with the banking system, I hope we're all fairly familiar and sympathetic to the idea that broad money supply, nominal broad money supply growth, is fairly closely related to nominal GDP growth, and therefore avoiding too much or too little money supply growth is the best way to avoid boom and bust. Now there's already a problem that we're going to come across with all of these debates, and that is that some of the people are underinformed about what it is we're talking about, and this is even assuming that they agree with the basic principles we're talking about here in terms of banks' importance to the economy. So here, for example, is a chart on the left, was the second chart, i.e. the first publication that Mark Carney did as Bank of England Governor, and it was chart 2, and it was showing, as he was keen to point out in the text, that unlike the US, this is the chart on the left, UK bank loan growth didn't go negative. So at least in the UK, the only problem was that bank lending didn't grow. What Carney was unaware of is that under the EU rules, the way that the central banks report bank lending is after excluding or adjusting for any actions by the banks themselves. And the main reason why bank lending goes negative is not because the banks stop lending so much, it's that they have to rebook the value of the loans after losses from non-performing loans. So since that's a bank action, that's taken out of the UK figures, so the UK stock of bank loans appears to be flatlining at zero. But that isn't what happened, as you can see if you take the unadjusted stock of bank lending, which is the chart on the right, which is replicating, you'll notice on, I've got a pointer, haven't I? I think I have one. So a pointer that doesn't work on the screen, okay, that's neat. Right, so if I just show you here, this is a sort of data gap. So if you could sort of mentally drop that part of the line down, then you'll see that it follows exactly the same as this chart for the US there. But the big difference is the blue line, which is UK bank lending. And if measured in the same way as US bank lending, then UK bank lending did indeed go negative, because of course UK banks were writing off loans. So the fundamental process that ruins the economy, if you like, during a banking crisis. So the banking crisis occurs when the banks have a significant enough amount of non-performing loans and losses on the foreclosures of those loans that it threatens in some way the solvency ratios. And a little aside, we're going to talk about solvency ratios, we're going to talk about capital, but it's worth bearing in mind that capital's a weird beast. You never actually use it. If your minimum capital ratio set by regulators is, for example, 10%, or 10% off, if it's 10%, then you never have much more than that, because it's inefficient to do so pre-crisis, and you can never dip into that post-crisis, because that looks like you're failing as a bank. So the point of capital is basically to assure the wholesale and retail funders of your business that you have sufficient capital so that they don't run. So all we're really trying to do is work out what it would be required to make sure that these people won't run. And as Jeff had pointed out, in the old days that argument worked a lot better, because each bank had to defend the amount of capital it had against their business model to their funders and say, look, well, this is more than enough. Oh, that's loud, sorry. So just briefly, so what happens in the crisis is, if money supply, which is bank deposits, which is the blue line, had continued to follow bank lending, which is the purple line, we would have had a nominal deflationary event and the Great Recession would have been much more like the Great Depression. And instead, as you can see from the grey line, money supply growth, which is, the grey line is merely QE added to bank lending. So what QE did was take money supply growth nominally up during a period when otherwise it would have contracted. So for those people who argue, what did QE do? It prevented us having the Great Depression. This is the same chart in the States, and as you can see, the yellow line is bank lending, the blue line is bank deposits, aka money supply, and the grey line is the Fed balance sheet on top of bank lending. So you can see that that's why deposits carried on going up. It's because of QE. And lots of people do say things like, what did QE ever do for me? Well, that's what it did. And you do it because of something quite exceptional when it comes to the environment. This shows that post-war in the US, these green circles show that bank lending in recession quite typically, bank loan growth quite typically goes to zero. But it doesn't go negative. Going negative is a crisis scenario. And when bank lending goes negative, it's because the stock of loans, as I said earlier, is being marked down because of the losses on those loans. Now, how do we define losses? I might just jump forward actually a slide. I don't do that way. So here's the chart of the US banking sector annual net income. And you can probably just see in 2009 a minus 10 billion figure. So on a net basis, the US banking system, which went into the crisis with a proper Basel III type CET1 capital, so proper loss absorbing capital, not all that other nonsense the regulator let them count as capital, like intangibles and deferred tax assets and prefs and just that nonsense. The proper cash on the balance sheet capital was about 500 billion. I mean, the IMF says it's 560 billion. Jamie Dimon says it's 495. It was around about 500 billion. And the losses were 10 billion. So we didn't have a crisis. But of course, what you can see there is not the losses. You can see the giant hole blown in the wall, as it were, and that's about 800 billion. So the banks are actually earning 800 billion less than normal during this crisis period. So if I just go back a bit, so this is looking at provisions, the blue line, and its impact on pre-tax income for US banking. Just prior to the pre-tax income hit from provisions was the hit from securities, like subprime securities, and post the hit on pre-tax income from provisions was another chunk of losses, which is from fines, etc., which have now, we heard last night, reached 350 billion worldwide. Put that in context, the total amount of losses on all subprime securities in the US banking system was around about 275 billion. So fines are bigger than what most people believe the financial crisis was. In actual fact, the largest chunk of the financial crisis came after the newspapers stopped reporting on it, and it was via loan loss provisions, which were about 800 billion. So here's the breakdown of these numbers for those of you who like breakdowns of numbers. In fact, none of you can even see that from where you are. But the interesting thing about this is that Geithner's team at the Treasury brought his New York Fed model over, where he'd be looking at Japan and other banking crises, and they based their model, adverse and extremely adverse, on the historical experience, which is about a 10% loss rate on loans. That's a 25% NPL rate and a 60% recovery rate. These are the average figures in banking crises. But unfortunately, it's worse if it's a synchronous crisis. Basically because the two ways that you can mitigate the damage of a crisis is to devalue your currency so your export sector can help trade you out a bit quicker. And also if your near neighbours can come over and cherry pick assets and put a floor under your real estate assets. So it's about 15% if it's synchronous. And Geithner's severely adverse scenario went for 15%. He sort of averaged it and said maybe it'll be about 12. So his estimate, and this is in March 2009, his team's estimate was 1.2 trillion for total losses on the crisis. And to date, these total losses cumulatively are about 1.45. Almost 2 years after Geithner's team, the IMF had a stab at it. So they had 2 years more knowledge and 2 years more time to do their sums. And they came up with a figure that was fairly lamentably a good 200 billion or so shy of what Geithner's team had come up with. And the other thing to point out about Geithner's figures is, in early 2009, the entire world, most of the world is still convinced of this, but at that time the entire world thought the crisis was almost entirely about securities. And if you look at the breakdown by silo of what Geithner's team were looking for in terms of losses, they were looking for 10 to 15% loan losses. So before there were any recognised loan losses in the system at all, Geithner said, well, I'm afraid guys, you're going to have to pay yourselves for what's going to come, because history tells you that's what you're going to get. And that's exactly what we got. So the point I'm trying to make is that the size of losses is relatively predictable if you just use history as your guide. These things are not unique. They happen regularly enough that we've got averages and special circumstances, etc. So if you're going to prepare a capital system that's going to convince everybody, so they don't run next time there's a worry, that you have sufficient capital to absorb the losses, you better have sufficient capital to absorb the sorts of losses we have already experienced. When you ask the Bank of England why they do a stress test based on a theory, and instead don't just say, well, would you have survived the last one? Their answer is a variation on the theme of, we don't really know what the last one cost. The FDIC has prepared these numbers, so in the US we know what it cost, but the Bank of England hasn't done a similar exercise. Although you can do it by going through annual banks, annual reports, etc. So the impact of the banking crisis, this is in the States, that red line to the middle there is Citigroup's net interest margin. And the lines top and bottom are the loan spread, the deposit to loan spread, and the bottom one is the yield curve, the 5 to 10 year yield curve. So what you can see is that banking didn't change much. Profitability didn't change much. It all plodded along quite normally. But there's this enormous hole was blown in the bottom line. And that enormous hole was blown by non-performing loans, so people defaulting. Now, if you're a bank, when do you account for these losses? Let's say year one of the crisis, you're pretty sure that about 25% of your loan book ain't going to make it. They're starting to make uncomfortable noises about, even if you lower interest rates as much as the drop to near zero in base rates suggests you should, I still may not be able to cover that out of my cash flow. But what do? What you do in banking terms is you modify your loan book. So you take someone whose loan is about to mature, and who can't possibly pay back principal, and you say to them, how about we extend it for 2 years and we do it at 1%? And they go, oh, well, I might just survive. And you create zombies. In Japan, they pretty much did that to the entire economy. But we had a lot of this happening in the West, the delay and pray type scenarios. So it's not the case that the banking system gets hit with all its losses all at once, which is why the losses, i.e. net of other retained earnings from the guys you've led to aren't going to us, net to about zero. Because if you're a bank and you've got all these losses coming up, you say, well, hold on, I'm making pre-tax, pre-provision about 1.5% a year on my assets. So I can afford to absorb this amount of losses each quarter without damaging my capital. Now, I mustn't damage my capital because if I expose my capital to downward pressure during crisis, pretty soon I'm out of business. Ask Dexia, who came 11th top out of 100 and something banks in the European stress test just before they fell over and died. So it's very important to control the story if you're a banker. So therefore, what the banks do is they spread it out. The average length of time for resolution, i.e. before banks go back to acting normally, in historical banking crises is 5.5 to 6 years. And that's about how long the Americans were. This time, we're closer to almost 10 in the UK. Our banks only started lending again properly last year, summer of last year. And the European bank loan growth to non-financials and non-governments is around about 1%. If you take the French out, it's 0. So it's pretty clear evidence the European banks. There may be some fixed ones in there, but in general, on average, they're not. And this long resolution period where banks can't lend because what they're doing is taking in money. They can't lend because their essential problem is they have too many risk assets for their capital, and they can't raise capital because everyone knows they're now in trouble, which means they have too many risk assets. And you can't get rid of risk assets, they're getting rid of themselves, unfortunately. But the one thing you don't do is add new risk assets. So therefore we have no increase in bank lending, and we slowly mark down the size of the loan book as the losses come in. But the important word is slowly. So you control the rate at which you make losses so that it doesn't impinge on your capital base. And that is why we have this bizarre idea of having huge losses if you go looking for them, but the sector doesn't actually make a loss, hardly ever. So if we have a look at banking crises, historic, and current. The blue lines show historic banking crisis, the Nordic banking crisis, about 15%. The Japanese couldn't lower their currency because they had an agreement with the Americans on defense, and they have no one as a nice near neighbor who even understands the language or the laws or anything, so they couldn't do either of the things you need to do. So they self-created, if you like, a synchronous crisis. They hit 20%. The US LATAM crisis was about 10.5%. The UK early 90s near crisis was about 8.5%, spread out over 4.5, 5 years. So again, exactly the same thing happening, it just wasn't quite as severe enough to be a crisis. And you can see where the orange bars show you where everyone else is fitting in at the moment, and the grey bars show that big difference between Southern Europe and Northern Europe. So what caused the crisis? Well, what caused the crisis was that banks, if you look on the left, thought that they had a capital to risk-weighted assets ratio of around about 7%. But if you look on the right, under Basel III, Common Equity Tier 1 definitions of capital, that was more like about 3%. And this is against risk-weighted assets. Now, the trouble with risk-weighted assets is that it's in banks' interest to rate their own assets as less risky. And we can see this happening when it was the case when this first started, that the average risk weights for banks' assets were about 2/3 of total assets, and now they're about 1/3. You can see that there's not much break in that line since the crisis. I mean, banks are still playing the same game. The average mortgage in Europe is risk-weighted at about 11%. But under Basel rules, it's 35%. Why the challenger banks always complain. They have to risk weight at 35%, they have to hold 3 times more capital than a big bank. If we look at it in a less manipulable, if you like, leverage ratio sense, you see that the leverage ratio for UK banks got down to about 2.5%, that's the yellow line. But if you look at the red line, which is the leverage ratio restated under Basel III definitions of capital, i.e. proper definitions of capital, loss-absorbing capital, it's a good 200 basis points lower. So is that telling us that in actual fact, UK banks' leverage ratio, if you properly measured capital, in 2008 was actually not 2.5, but 0.5%. Well, understandably, the Bank of England hasn't included that red line to the left, but we know why. I mean, it was pretty clear that under the old rules, banks were allowed to operate with virtually no capital. I mean, famously, the RBS investigation suggested they had about 2% of loss-absorbing capital compared to assets, but they were absolutely not alone in that sense. So if you want to have a look at banks today, have they improved a lot? This is banks' risk-weighted capital ratios. And as you can see, it's not exactly a clear distribution, is it? When you ask the banks whether they have enough capital, and they're still allowed to risk-weight their assets, even though they're not any longer allowed to play around with the definition of capital, they're still able to basically push themselves all over on the right-hand side, which is, as you see at the bottom from the x-axis, a strong bank. Interestingly, the strongest bank up there, by miles, the only bank that carried on lending all the way through the crisis, is Wells Fargo. And interestingly, Wells Fargo is actually the lowest scoring bank on a CET1 to risk-weighted asset basis. So we still have an awful lot of potential and actual gamesmanship going on by banks in terms of telling their story. We can undo this by looking at, say, we can create leverage ratios are normally defined by Tier 1 capital, which buys the banks, or many banks have additional Tier 1 instruments, which is COCOs and things like that, which are unproven in battle and maybe can't absorb a loss, but you're allowed to use them in your leverage ratio, and the minimum leverage ratio anyway is only 3%. I mean, you know, I'm about to argue, if I've got time, that it should be at least 5, if not 6 or 7. But you'll see that a lot of European banks, these black banks, many European banks, are far too far to the left when we actually use CET1 capital and divide that by their leverage exposure. American banks, the red ones, much further off to the right, therefore stronger and fixed. And this is after we've leveled the playing fields for the difference between US GAAP and IFRS accounting, for those of you who are accounting nerds in the room, because the whole point about the new leverage exposure figure is that it undoes those differences in measuring total assets. So we actually have a leverage ratio we can compare across borders. So to end up, how much money did the banks lose in the crisis? So I've gone through bank by bank, and I've gone through loan loss provisions, securities losses, legal settlements, restructuring costs, the whole kit and caboodle. And if you have a look, I can't point because it doesn't work on the screen, but if you have a look at near the bottom, there's total losses, and then you've got a loan loss rate, and you've got a loss rate of total losses against total assets, and so you can mix up any way you like. And basically, from a loan loss rate point of view, UK banks are hitting about 10%. So a typical banking crisis loan loss rate. There are other losses on top of that, including securities, and arguably most securities are securitized loans, so arguably you should include them on the loan losses, which is taking us, of course, closer to the synchronized banking crisis type of loss figures. The US banks in there, you're getting up to an average of 15% on loan losses, 20% in the case of Citigroup. So we can see the sorts of size of losses that banks made. Now these are losses compared to the norm and not included yet, or being offset yet, by retained earnings from the non-loss making loans that are still running. But the principal point here is that the only difference between a bank that doesn't make a loss and survives a crisis and one that doesn't survive the crisis is time. If you make the banks recognise all their losses in year one, they're out. These loss figures are massively larger than starting capital. And so what you're going to do, say for example with IFRS, which of course they won't implement it, or not properly, but what you're doing with IFRS is you're arguably saying to the banks, I want to know up front how many of these modified loans you have on your book are actually defaulting loans that you're delaying the crystallisation of the losses on. Because then I'll know what the true state of your balance sheet is. And what they'll discover is that the true state of any bank's balance sheet at the beginning of a crisis, under those conditions, would be, I'm insolvent. Not regulatorily insolvent, I don't have quite enough capital. I mean, I have losses which are bigger than my entire holding of capital. So based on these sorts of losses, how big should the capital position of banks
James,
be?
let me just remind you that you have just a minute.
I don't even need 1 minute. I'm that good. So basically, if you look at the loan loss rates, we're looking at loan loss rates of about 10% for the Great Financial Crisis, maybe 15%. Now, normally going into a crisis, risk assets are about 2/3 of banks' balance sheet. The other 1/3 having to be risk-free liquidity instruments in order to satisfy the liquidity requirement Jeff was talking about. So if you're making a 10% loss rate on 2/3 of your balance sheet, your total losses as a proportion of total assets is 6.5%. And once in a generation or once every century, you might make losses which are equivalent to 10%. So the first point is there would be no justification based on history for having capital ratios that made banks hold as much as 10% against their assets. Don't forget, we never use this capital. This capital is only there for PR. We actually bail ourselves out as banks through retained earnings over the post-crisis period. And there wouldn't be much of an argument to have more than, say, 6 or 7%. It is there to be a nice, big, chunky figure to make everyone feel happy, to not run, but we don't want to have it too large, because if you have it too large, it impinges the rate of growth for banks and would impinge on their interest and ability to lend. And so my piece that I wrote, that I presented to the House, is basically discussing the Dimon versus Kashkari argument. Dimon is saying, we've gone too far, we've raised too much capital now. And Kashkari is saying, no, you haven't done enough. Oh, that's already doubled, it should double again. I think Kashkari is talking about, he gets muddled up between risk-weighted assets and total assets anyway, but he's talking about taking capital ratios to sort of 20%. This is dangerous and unnecessary. But Dimon's also wrong to be trying to push down again, because now we are up at the sorts of figures that if we had them pre-crisis would have actually mitigated a lot of the damage. Okay. And this is the same sort of stuff on Europe.
Thank you.
Loads of numbers.
Thank you so much.